Welcome back to our comprehensive market analysis podcast, where we dissect the latest developments in the world of finance. In this segment, we'll delve deep into the intriguing and often interlinked worlds of currency and commodity markets. These markets are like the pulse of the global economy, offering vital insights into economic health, investor sentiment, and the broader financial landscape. Currency markets, where the world's major currencies compete for supremacy, have been roiled by recent events. The surge in bond yields, driven by expectations of tighter monetary policy, has sent ripples through these markets. Investors are closely watching how currencies respond to this turbulence, as currency values impact international trade, inflation, and overall economic stability. And in the realm of commodities, where tangible resources like oil and gold hold sway, we've witnessed significant shifts. Crude oil prices have been on a rollercoaster ride, reacting to evolving demand dynamics and geopolitical tensions. Meanwhile, gold, often referred to as the ultimate safe haven, has faced its own set of challenges in a world of rising interest rates. As we navigate through these complex markets, we'll explore the factors driving these changes and consider their potential ramifications for both the global economy and individual investors. First, Korean and Japanese stock markets experienced significant declines. This decline was prompted by the US 10-year Treasury yield reaching its highest level in 16 years, standing at an astonishing 4.793%. Now, why does this matter? Rising Treasury yields often lead to concerns about increased borrowing costs, which can affect companies' profitability and borrowing decisions. When this happens, stock markets may react negatively, as they did in this case. Specifically, South Korea's Kospi fell by 2.41%, closing at 2,405.69. At the same time, the Kosdaq, which features smaller cap stocks, slipped by 4% to end at 807.4, following a holiday. In Japan, the Nikkei 225 shed 2.28%, closing at 30,526.88, its lowest since late May, and the broader Topix traded 2.49% lower, closing at 2,218.89. Meanwhile, in Australia, the S&P ASX 200 fell by 0.77%, closing at 6,890.2, and Hong Kong's Hang Seng Index experienced another 0.94% decline, reaching its lowest level since late November. It's worth noting that China's markets remained closed for a week-long holiday. So, why did these markets react this way? The rise in Treasury yields can be seen as an indicator of potentially higher interest rates in the future. When investors anticipate higher borrowing costs, they may reassess their investments, leading to market adjustments like the ones we've seen. Now, let's pivot to the broader implications of these market movements. When Asia-Pacific markets, which are deeply integrated into the global economy, experience significant shifts, it can send ripples throughout international financial systems. Investors worldwide monitor these developments closely as they may signal broader trends in the global economy. So, while these events may seem region-specific, their repercussions are felt on a much larger scale, emphasizing the interconnectedness of today's financial markets. Turning our attention to Thailand, the Tourism and Leisure Index on the Stock Exchange of Thailand faced a challenging day. This decline occurred in the wake of a tragic incident, a shooting at a downtown Bangkok mall popular with tourists. As a result, the Tourism and Leisure Index saw a drop of approximately 3.8% on the day. Notably, Central Plaza Hotel, a constituent stock on this index, was down around 2.7% in early trading. This decline marked it as a standout underperformer, while the broader Set Composite Index also retreated by 0.6%. The incident serves as a reminder of how external events, especially those impacting tourism, can have swift repercussions on financial markets. Investors and traders are keeping a close eye on developments in Thailand's tourism sector as they assess the potential longer-term impact of such incidents on the economy and related industries. Now, let's pivot to South Korea's stock market, which faced a 2% decline on this particular day. The downturn was primarily driven by weaknesses in the technology and distribution sectors. Travel agency Lotte Tour Development, in particular, experienced a substantial decline of 11.3%, reflecting challenges in the travel industry. Cosmetics companies, including Abel C&C and Hankook Cosmetics, also saw their stocks tumble, highlighting concerns about consumer sentiment. Additionally, South Korea's electronics sector, including giants like Samsung Electronics and SK Hynix, faced declines. These fluctuations in the Korean stock market showcase the sensitivity of markets to both domestic and global factors. As South Korea plays a crucial role in the global tech industry, developments in its stock market can have a cascading effect on the broader tech sector worldwide. In our next segment, we'll explore how these regional developments are interconnected with broader global market trends, so stay tuned for that analysis. Turning our attention to currency markets, we witnessed an intriguing development in the value of the Japanese yen. After briefly touching 150 yen against the US dollar, a level it hadn't seen in quite some time, the yen strengthened. This abrupt fluctuation raised questions about possible interventions by the Bank of Japan, BOJ, to support the currency. Japan's Finance Minister Shunichi Suzuki refrained from commenting directly on such interventions but stated that Japan would consider taking action against any significant currency fluctuations. These moves underscore the delicate balance central banks maintain in ensuring currency stability. Shifting to New Zealand, the Reserve Bank of New Zealand recently announced its decision to leave its key interest rate unchanged at 5.5%. Despite stronger than forecasted GDP growth in the June quarter, the central bank expressed concerns about subdued economic outlook and inflation. This decision aims to maintain a restrictive monetary policy stance to support the country's economic goals. The S&P NZX 50, New Zealand's benchmark stock index, reacted to this news, trading down by 1.13% on the day. These developments highlight the pivotal role central banks play in shaping a nation's economic trajectory and how their decisions can reverberate through various sectors, from currency markets to equity indices. In recent days, global financial markets have been rattled by significant turbulence in the bond market. This turmoil, characterized by soaring yields, has sent shockwaves across various asset classes and raised concerns about its implications for the broader economy. The epicenter of this turmoil has been the surge in bond yields, particularly in the United States. The yield on the benchmark 10-year U.S. Treasury note touched a remarkable 4.88%, a level unseen in 16 years, during early London trade. The 30-year Treasury yield also climbed above 5%, reaching heights not witnessed since August 2007. Now, why is this significant? Rising bond yields are often seen as a barometer of economic sentiment. When yields climb, it can signal expectations of stronger economic growth and, in this context, concerns about inflation. These factors have led investors to reassess their portfolios, which has sent shockwaves across the financial landscape. So, how has this bond market turmoil affected other financial markets? Equities, for one, have felt the tremors. Global stock indices, including Europe's Euro Stock 600, have struggled amid growing concerns about the impact of higher interest rates on corporate earnings and valuations. Crude oil and gold prices have also been impacted, with both experiencing declines due to worries about the potential dampening effect of high interest rates on global economic growth. Amid this bond market turbulence, all eyes are now turning towards the upcoming unemployment report, scheduled for release on Friday. Market experts view this report as a critical indicator that could influence future market trends. The recent cooler-than-expected U.S. private payrolls report provided some relief to investors, helping Wall Street stocks rebound from a sharp sell-off. However, the September unemployment report will likely be a significant focal point for investors, as it may offer further insights into the health of the labor market and the trajectory of interest rates. Additionally, market expectations for a rate hike by the Federal Reserve have fluctuated. Despite the recent turmoil, expectations for a rate increase in November slid to 23.7%, down from 28.2% just the day before. The futures market now suggests that the Fed's overnight rate will remain above 5% through next July, reflecting the uncertainty surrounding the path of monetary policy. To put this all in context, the bond market turmoil underscores the interconnectedness of global financial markets. Movements in bond yields can have a cascading effect, influencing not just fixed-income investments but also equities, commodities, currencies, and more. It's a reminder of how sensitive the financial ecosystem can be to shifts in economic expectations and policy decisions. As we await the employment report and further developments, investors and analysts will closely monitor how these bond market dynamics evolve and what they may signal for the broader economic landscape. Bond markets often serve as a barometer of economic health, and the recent turbulence suggests that we are navigating uncertain waters in the financial world. In the wake of the recent turbulence in the bond market, one key factor that's been under the spotlight is the expectation of interest rate hikes by central banks, particularly the Federal Reserve in the United States. These expectations have a profound impact on market sentiment and can influence various asset classes and investor behavior. So, what exactly are rate hike expectations? When we talk about rate hikes, we're referring to central banks, such as the Federal Reserve, increasing their benchmark interest rates. These rates serve as a foundational element of the financial system and have a ripple effect on borrowing costs, investment decisions, and economic growth. Financial markets are incredibly sensitive to shifts in interest rate expectations. When investors believe that central banks are likely to raise interest rates, it often triggers adjustments across various asset classes. Let's break down how this plays out. Impact on equities. A perceived increase in borrowing costs can put pressure on corporate earnings and reduce the attractiveness of stocks. As a result, equity markets may experience declines as investors re-evaluate their risk-return profiles. Effect on bonds. Higher interest rates can lead to falling bond prices, as newly issued bonds with higher yields become more attractive. This inverse relationship between interest rates and bond prices is a fundamental concept in the fixed-income market. Currency movements. Expectations of rate hikes can influence currency markets. When a central bank is seen as likely to raise rates, its currency may appreciate as investors seek higher returns. Conversely, currencies in regions with expectations of rate cuts may weaken. Commodities, the commodities market, including oil and gold, can also be affected. Higher interest rates can dampen economic growth expectations, potentially leading to reduced demand for commodities. Consumer behavior, interest rate expectations can impact consumer behavior. For instance, higher rates may discourage borrowing for big-ticket items like homes and cars, which can, in turn, affect industries like real estate and automotive manufacturing. Central banks often find themselves in a delicate balancing act. On one hand, they aim to control inflation and maintain economic stability by adjusting interest rates. On the other, they need to be mindful of not stifling economic growth or creating financial instability through overly aggressive rate hikes. As we've witnessed in recent market movements, shifts in rate hike expectations can inject uncertainty and volatility into financial markets. The resulting market sentiment can be a powerful force, impacting investor decisions, asset valuations, and economic outcomes. Against this backdrop, market participants closely watch central bank communications and economic data releases for clues about future rate actions. The Federal Reserve's upcoming decisions, in particular, will be closely scrutinized for their potential to influence market sentiment and, consequently, asset prices. In sum, rate hike expectations are a fundamental driver of market sentiment. They underscore the intricate dance between central banks' policy decisions and the financial markets' reactions. As we navigate these evolving expectations, investors and analysts will continue to assess their implications for various asset classes and the broader economic landscape. Let's move on to global equities. Over the past few sessions, we've seen a mixed bag of performances across different regions. In the United States, major indices like the S&P 500 and Nasdaq Composite have shown resilience, with tech giants like Apple, Amazon, Microsoft, and Tesla leading the charge. This has helped these indices recover from recent losses. However, the situation is not the same everywhere. In Europe, the Euro Stoxx 600 has experienced a decline for the third consecutive day, reflecting concerns about economic growth and consumer spending, particularly in the retail sector. European stocks, especially in the retail industry, have faced headwinds amid a pullback in consumer spending. Meanwhile, in Asia-Pacific markets, we've seen some significant drops, with the MSCI Asia-Pacific Index hitting 11-month lows. Concerns about slowing global growth, bond market volatility, and uncertainties around interest rate hikes have been key drivers of this decline. The bond market has been at the epicenter of recent market turbulence. Benchmark U.S. yields, in particular, hit 16-year highs above 4.88%, reflecting investors' concerns about persistently high interest rates and their potential to slow down global economic growth. It's worth noting that bond yields and prices have an inverse relationship, meaning rising yields often lead to falling bond prices. This bond market turmoil wasn't limited to the US. European bond yields also saw a significant rise, with Germany's 10-year debt surpassing 3% for the first time since 2011. Even Japan's 10-year yield, which is typically kept low by the Bank of Japan, reached a decade high. The surge in bond yields has led to a stronger US dollar, impacting currency markets. The dollar's rise against other major currencies has been notable, with the dollar index, which measures its strength against a basket of currencies, gaining ground. In the commodities space, we've witnessed some noteworthy moves. Crude oil prices have taken a hit, with West Texas Intermediate dropping below $85 a barrel, partly due to concerns about global economic growth and the possibility of weakened demand for oil. Gold, often seen as a safe haven asset, has faced headwinds due to elevated treasury yields and the expectation that the Federal Reserve will keep interest rates higher for an extended period. As a result, gold prices have continued their decline. All these global market dynamics are interconnected, creating a complex web of cause and effect relationships. Investors are closely monitoring central bank policies, economic data releases, and geopolitical developments, as these factors can sway market sentiment and asset prices. In this ever-evolving landscape, staying informed and adapting to changing market conditions are essential for investors and market participants. We'll continue to keep you updated on the latest developments in global financial markets. Thanks for tuning in. In this next segment, we'll focus on the intriguing developments in currency and commodity markets, which play a pivotal role in shaping the global financial landscape. First, let's talk about the currency markets. The recent turmoil in bond markets, driven by rising yields, has had a significant impact on the value of currencies around the world. The US dollar, often viewed as a safe haven currency, saw notable strength as investors sought refuge amid uncertainties in financial markets. The dollar's resurgence was so pronounced that it even gained strength against the euro, pushing the European currency to its lowest level in 10 months. Sterling, the British pound, also hit a 7-month low against the dollar. While these moves reflect short-term fluctuations, they underscore the interplay between currency markets and broader economic conditions. Meanwhile, the Japanese yen had a rollercoaster ride. It briefly breached the 150 per dollar level before unexpectedly surging to 147.3, sparking speculation about potential Japanese intervention to support their currency. While there was no official confirmation from Tokyo, this incident highlights how central banks can influence currency values. Shifting our focus to commodity markets, let's begin with crude oil. Oil prices experienced a sharp decline, with West Texas Intermediate, WTI, falling below $85 a barrel. A key driver of this decline was the concern about global economic growth, which could lead to weakened demand for oil. Additionally, reports that Russia might lift its diesel ban in the coming days added further pressure to oil prices. Gold, often seen as a traditional safe haven asset, has not been immune to the recent market dynamics. Elevated treasury yields, fueled by expectations that the Federal Reserve will maintain higher interest rates for an extended period, have weighed on investor sentiment towards gold. As a result, gold prices have faced downward pressure, declining for the 8th consecutive session. These movements in commodity markets have broader implications for various industries, including energy and mining. Commodity prices can influence inflationary pressures, production costs, and, ultimately, corporate profits. Currency and commodity markets are integral components of the global financial ecosystem, often reflecting broader economic trends and geopolitical events. The interconnectivity of these markets means that developments in one area can ripple through the entire financial landscape. As investors and market participants, it's crucial to stay informed about these dynamics, as they can have a significant impact on investment strategies and portfolio decisions. We'll continue to provide you with insights and updates on these vital market segments. Thanks for tuning in. In conclusion, the intricacies of currency and commodity markets offer a fascinating lens through which to view the global financial landscape. They are not just about numbers and prices, they are about the very heartbeat of the world's economies. Currency markets, reflecting the value of nations' money, are a mirror of economic health and geopolitical stability. The ebb and flow of currencies can impact everything from the cost of imported goods to the profitability of multinational corporations. Commodity markets, on the other hand, deal in the tangible resources that fuel our world. They are the barometer of supply and demand, and their fluctuations can sway industries from energy to agriculture. As we wrap up this segment, it's clear that currency and commodity markets are critical elements of the intricate financial web that connects our world. We'll continue to monitor these markets and bring you the latest insights, because understanding them is key to making informed decisions in today's ever-evolving financial landscape. Thank you for joining us today on this exploration of currency and commodity markets. Stay tuned for more in-depth analysis and market updates in our future podcasts. Let's journey into the Asia-Pacific region, where financial markets have recently encountered turbulence driven by various factors. On a broader scale, this turbulence has implications for global finance.